Have you ever heard the saying, money is the root of all evil? It warns against falling into debt, which can become a form of enslavement. To some extent, this holds true because being burdened by debt can consume your life. While you're struggling to repay what you owe, your debts continue to grow. No one lends money for free. There's always interest involved. Despite this, the United States has accumulated an astonishing $15 trillion in consumer debt, translating to an average household debt of over $5,300. This debt almost equals the entire U.S. GDP, which is slightly above $21 trillion. However, here's some uplifting news. Not all debt is detrimental, despite its generally unfavorable reputation. Most of the debt we carry is considered bad debt. For instance, many people have credit card debts, car loans, and perhaps even student loans, leaving them thinking it will take decades to clear these financial obligations. But, surprisingly, there's a positive side to this, and I'll explain how wealthy individuals leverage debt to further enrich themselves. This might sound perplexing because why would someone with substantial wealth resort to borrowing? Isn't debt usually associated with those lacking funds? Well, that's not how capitalism always operates. When used strategically, debt becomes a powerful tool, and in this video, we'll explore how the affluent harness it to amplify their wealth. Please like this video, and let's dive right. Number 1. Strategic use of debt in business. In the world of finance and entrepreneurship, leveraging debt as a strategic tool can be a game changer. Often, people perceive debt as a burden, something to avoid at all costs. However, this perspective doesn't take into account the potential benefits of responsible borrowing. Imagine you want to start a business, and you need capital to purchase inventory. Traditionally, one might have to invest their savings or seek outside investors. But in today's globalized economy, there's another option: borrowing from suppliers. Over the last 5 decades, China has become the manufacturing hub of the world, producing a wide range of products. Many factories in China are willing to extend credit to businesses, allowing them to obtain products without immediate payment. This practice is based on trust and often entails building a solid working relationship with these suppliers. Once the products are sold in the target market, the revenue generated can be used to repay the supplier, creating a win-win scenario. Entrepreneurs can sell products without tying up their own capital, while suppliers can focus on production without the financial burden of storing inventory. This demonstrates how debt, when used strategically, can help businesses flourish. Number 2. Real estate debt and tax benefits. Real estate has long been considered a safe and potentially lucrative investment. When it comes to purchasing real estate, particularly for investment purposes, debt can play a critical role. Take, for example, the scenario of an individual with substantial savings who aims to invest in real estate. If they were to purchase a property worth $800,000, they would need to provide a 20% down payment of $160,000. However, their savings might not cover the entire cost of the property. Instead, they could explore a property valued at $500,000, which needs some renovation. By securing a mortgage with a 20% down payment, they invest $100,000 and allocate another $50,000 for renovations. After completing the renovations, the property's market value increases to $700,000. Now, they can refinance the mortgage, accessing $560,000. This amount allows them to repay the initial mortgage and renovation costs, leaving them with an extra $110,000 in profit. What's more, this profit is essentially derived from using debt strategically to invest in real estate. Furthermore, holding multiple mortgages can lead to significant tax deductions, reducing the overall tax burden and further increasing returns on real estate investments. Number 3. Hedge funds and unconventional strategies. Hedge funds are financial entities designed to cater to the wealthy, offering unique investment opportunities and unconventional strategies. Unlike conventional investors who seek to identify companies with growth potential, hedge funds often adopt a contrarian approach. They look for opportunities in companies on the decline or facing financial distress. A prime example of such an approach was the GameStop saga, where hedge funds bet against the stock's rise. One of the more intricate strategies employed by hedge funds is shorting stocks. This involves borrowing shares of a company and selling them immediately, anticipating that the stock's price will fall. If successful, the fund can buy back the shares at a lower price, returning the borrowed shares and pocketing the difference as profit. However, this approach carries substantial risks, as losses can accumulate if the stock price rises instead. Hedge funds have the advantage of employing teams of experienced analysts and significant resources to mitigate these risks. It's a strategy that highlights the potential rewards and pitfalls of using debt as an investment tool. Number 4. The Forex market and currency trading. The Forex, foreign exchange, market is a dynamic arena where currencies are traded. It plays a pivotal role in international trade by facilitating the exchange of one currency for another. Currency values fluctuate based on various factors, including economic indicators, geopolitical events, and interest rate changes. This market offers a unique opportunity for individuals and institutions to profit from these fluctuations. What sets Forex apart is the concept of leverage, where traders can borrow a multiple of their initial investment. For instance, with $1,000, a trader can control a position worth $100,000. While this amplifies the potential for profits, it also escalates the risk, as losses can exceed the initial investment. Successful Forex traders are skilled in predicting currency movements and managing risk. It's a market where effective risk management is essential, and where the strategic use of debt can magnify both gains and losses. Number 5. The importance of credit scores. A person's credit score holds significant influence over their financial life. It serves as a measure of creditworthiness, influencing access to loans, interest rates, and financial opportunities. In essence, it reflects a person's history of borrowing and repaying debts. A higher credit score typically results in more favorable lending terms, while a lower score can limit borrowing options and lead to higher interest rates. Building a solid credit history is crucial for individuals and businesses alike. It opens doors to better financing opportunities, such as lower mortgage rates, reduced credit card interest charges, and more favorable terms for loans. Banks and financial institutions place great emphasis on credit scores when assessing an applicant's risk profile. Demonstrating responsible borrowing behavior by consistently meeting debt obligations is a key strategy for improving credit scores. In conclusion, these 5 points illustrate the multifaceted nature of debt in the modern financial landscape. When used strategically and responsibly, debt can be a valuable tool for individuals and businesses, offering opportunities for investment, tax benefits, and financial growth. However, it's essential to approach debt with caution and a clear understanding of the risks involved, as poor management can lead to financial difficulties. If you are looking for ways to make more money, I recommend you watch this video next. Do not hesitate to share this video with friends, subscribe to the channel, and share your thoughts on today's video. Thanks for watching, and I'll see you in the next one.